Very good morning, friends. So I hope you're all doing well. And as I keep always saying, I hope your cumulative revision is going on. So we were talking in terms of consolidation standards, and we are talking in terms of Ind AS 28, accounting for investments in associate as well as joint venture. So in the previous session, we had discussed the aspect of the block one, wherein we discussed the concept. How do you assess that there is a significant influence? I think I'll not make any mind maps on that. That was a pretty easy section indeed. And then we started a journey on the block number two. In fact, there is one more agenda which I've intentionally left, which can be related to the block number one, and that is the scope of the standard. But I'm going to talk of this a little later once we have done the aspect of equity method of consolidation. I'm going to come back to the block one and discuss the scope of the standard as well. That's a little technical area. There have been, I think, one or two questions which came in the RTPs on the scope of the Ind AS 28 as well. But I think prior to that, let's concentrate on the block number two. And I'd given you conceptually that what is the concept of equity method. We are going to do the practical illustrations today on that particular part. But I think let's first begin with a little warm-up exercise and make a quick summary chart, a mind map in terms of how do you work out the things under equity method of consolidation. Just to remind you, every standard which deals with consolidation has got a different technique of consolidation. Like for example, when we saw Ind AS 110, it talks about consolidation technique, which is called a full consolidation. Full consolidation in the sense that you aggregate all the assets and liability, irrespective your percentage is 60, 80 or 100%. Then the second standard dealing with consolidation is Ind AS 28, which deals with a technique called equity method of consolidation, or what we generally popularly call one-line consolidation, where the assets and liabilities are not consolidated, but just the investment appears in the consolidated balance sheet as a single line item. And then there is another technique as well, which you're going to learn, of course, not today, in the next session. That is Ind AS 111, which is consolidating only to the extent of share in the assets and liability. It's not technically correct to call it as a proportionate consolidation because that term was used much earlier. But I think for the understanding perspective, let's call this as a proportionate consolidation. So three different standards on consolidation and three different techniques on consolidation. 110 based on a full consolidation, 28 which is based on one line, and 111 which is based on a proportionate consolidation. But I think it's important to tell you that irrespective of the type of consolidation technique, depending upon the type of relationship, the essence of consolidation remains the same. Now, what do I mean by essence of consolidation? That you will realize once I come to the equity method in detail, you'll see that irrespective the way you consolidate, whether it is a full consolidation or it's a one line or it's a proportionate consolidation, the net impact, the essence of consolidation, irrespective of the standard, remains absolutely same. So right now, let's concentrate on a mind map on one-line consolidation equity method as per Ind AS 28. So I'm just making a quick mind map before we do the practical illustrations on equity method. So we're looking at the block number two in specific, which we've already discussed, and this is the application of equity method of consolidation. So I always tell people that, when you're looking at a consolidation under Ind AS 28, just apply a simple two-step model. So I'm going to call this as a two-step model. That'll keep us absolutely correct on the application of this method. So we're going to apply a simple two-step model in step number one, which is applied on the date of acquisition. The step number one is applied on the date of acquisition, wherein you just need to compare You just need to compare the purchase consideration versus the share in net assets of the associate. So we pick up the share in net assets of the associate, and remember, this net assets are taken at a fair value and on the date of acquisition. So there are two key focus points when you compare the share in the net assets. You need the net assets on date of acquisition and they're taken at a fair value. So isn't that something similar what we do in 110? Yes, that's what we do in 103 as well, which is nothing but done in 110. So in this particular case, the idea is to compare what you paid with the share in the net assets of the investee company, the associate company. So when you compare this and the difference is greater, then we call this as a goodwill. And when it is less, we're going to call this as a capital reserve. And this goodwill or the capital reserve is not a separate line item. It is not a separate line item. It does not appear as a separate line item in the consolidated balance sheet, but it's a part of the carrying value of the investment. So it is shown as a part of the carrying value of the investment. It's a part of the carrying amount of the investment which appears in the consolidated balance sheet. So I think the first step is pretty simple and straight, is just identifying the premium, the goodwill paid, or the gain, which is a capital reserve, but it's never a separate line item in the balance sheet. It's reflected as a part of the carrying amount of the investment in the balance sheet. Which also adds another interesting point, that goodwill never gets impaired under Ind AS 28. The impairment will be of the investment, and impairment will not be of goodwill. In 110, there is a goodwill impairment, but in terms of 28, there is an investment impairment. There is no goodwill impairment which occurs. So that we'll discuss when we come to those 5 adjustments, because I need to map those 5 adjustments also today with you in Ind AS 28, balance sheet and the P&L, and then comprehensive questions as well. Okay, so this is step 1, and then comes the aspect of the step number 2. Now, when you look at the step number 2, in terms of the step number 2, this is post-acquisition changes. So this is the post-acquisition changes, which means you track the changes in the net assets of the associate company. So we need to consider that how the net assets of the associate has undergone a change. So you can say on one hand is the investor, and the other hand is the investee, or you call it as an associate company. So what you need to do in this particular case in step 2, you need to track the changes in net assets. You need to basically track the changes in the net assets. I always tell people that that's how you go to function. Look at the changes in the net assets of the associate company. If the net assets of the associate company increases, you also need to increase the investment. In other words, debit the investment. If the net assets of the associate in a post-acquisition goes down, you also need to decrease the investment, that is, give a credit to the investment. But this debit or credit to the investment is to the extent of share. So this is to the extent of share. It is to the extent of share in the increase. It is to the extent of share in the increase or decrease, as the case may be. So if the net assets of the associate goes up, I'll calculate my share, investment debit. The net asset goes down, I'll calculate my share, investment gets a credit. And then I also gave you that when you're considering the debits or credit, the corresponding, if you look at the corresponding we can say credit or debit. So when you debit the investment, you need to correspondingly credit something. when you credit the investment, you need to correspondingly debit something. And that's what I said is going to be a mirror accounting. That's what we said is going to be a mirror accounting. So I'll just put across a very simple question. Did the associate credit the P&L? I also credit the P&L. Did he credit the OCI? I also credit OCI. He debit the P&L. I debit the P&L. He debit the OCI. I debit the OCI. He directly records it in equity. We directly record it in equity. As simple as that. So you can say the corresponding credits or debits would be to the P&L or to the OCI or directly in terms of SOKI, that is equity. Simple and straight. Little more inputs we'll take care later, but this is how the equity method of consolidation, what we said, technically it's called a one-line consolidation. It's called a one-line consolidation because only investment appears in the balance sheet of the company. I think this helps. So now what we're going to do, we're going to do some plain vanilla questions on the application of equity method of consolidation. But I think before that, there is a need to create a chart indicating the 5 adjustments which we did. What is the role of those 5 adjustments in terms of this method? So before we do the practical illustrations with you, let's make an interesting chart. This we did not discuss last time. So I'm just going to consider all the 5 adjustments and the application of all the 5 adjustments with reference to the consolidated balance sheet. So let's consider the same list of adjustments and see the impact of these adjustments. Right now, we're looking at these adjustments with reference to consolidated balance sheet. I'm not talking in terms of consolidated P&L right now. The focus is on the consolidated balance sheet. So I think let's see the adjustments and let's see what is the accounting treatment of these adjustments. So the first adjustment which I gave you is the intercompany owings. So I think let me rather divide this in 5 parts. Intercompany, then we had stock reserve, then we had goodwill impairment, in this case, investment impairment, fair value changes, and if there is any kind of omission. So I think if you get this straight, I don't think so equity method is a complicated method at all. Now, let's think on a logical level. If there is any intercompany owings, a common debtor-creditor relationship between the investor and the associate, I have no concern. Because in the equity method of consolidation, you're only presenting the investment in the balance sheet as a single line item. No assets and liabilities have been aggregated. So can I say if there is any intercompany owings, we can say it is simply ignored. So even if the question gives you that information, we are not at all concerned. Simple and straight. Let's consider the second adjustment. That's crucial. That is the stock reserve which we discussed. Now, in this particular case, it would again be either downstream in nature or it is going to be upstream in nature. Now, it's time to visualize something. Now, when you say it is downstream, it is a sale by the investor to the associate. Now, please keep the focus very clear. If it is downstream, then it is a sale by the investor to the associate. So who's got the stock? The stock is with the associate. And does that appear in the consolidated balance sheet? No. You get the logic's very clear. When the investor sold the stock to the associate company, the stock is with the associate, and that does not appear in the consolidated balance sheet. So this stock is at an increased value, which means the net assets of the associate has gone up, because this net assets is including this inventory at a selling price. So in this particular case, you can say the net assets have got increased, and the parent in this particular case, when he calculates the post-acquisition changes, in the net assets, his investment value would go up because the net assets have gone up because of the stock at a selling price. The investment value is carried at a greater value. So what do we need to do in this particular case? If it is downstream in nature, I will reduce the amount of stock reserve. I'll reduce the amount of stock reserve from the investment, and correspondingly, I'll also have to reduce the element of stock reserve from the other equity as well. Because the parent, not the parent, I would say the investor made a profit on this deal, so you need to reduce the other equity as well. So reduction of the other equity and reduction of the investment. Now, one thing which you need to be careful on, when it was Ind AS 110, the stock reserve elimination was 100%. 100% in the sense, let's say if there is an unsold stock and you calculate a stock reserve, let's say 2000, you reduce the entire 2000. In this case, when you calculate the stock reserve, we will not make a reduction of the 2000. In this particular case, the reduction will be to the extent of share in associate company. It will be reduction to the extent of share in the associate company. So if you got a 25% share, I'll not reduce 2000, I'll reduce 25% of the 2000. So this is one thing you need to be careful. In a subsidiary, you eliminate the stock reserve full. But in terms of associate, you need to eliminate the share in the unrealized profits. So in my example, if I take 2000, I'll take 25% of 2000. Next, if it is supposed to be upstream in nature, now watch this. If it is upstream, the associate company made a sale to the investor. The stock is with the investor, and that is appearing in the consolidated balance sheet. So in this particular case, what I will do, I will make a reduction not from the investment, but this is to be done from the stock. And correspondingly, this is going to be done from the other equity. So in the consolidated balance sheet, I think it's easy to remember. If it is downstream, the stock is with the associate, and that doesn't appear in the balance sheet. So investment. And if it is upstream in nature, the stock is with the investor, and that appears in the consolidated balance sheet. So you can eliminate the profit from the stock. So in a downstream, elimination will be investment, upstream will be stock, and it's going to be other equity to eliminate the profit element. Of course, to the extent of share. I hope, friends, I stand clear on the downstream, upstream element, because I think this is the only crucial adjustments in terms of equity method of investment accounting. That's perfect. Now let's go to the next one. And in the next one, we're looking at number 3, and that is fair value adjustments. And that is fair value adjustments. Now, fair value adjustments is going to result in changes in the assets and liability. I'm not concerned, because we do not aggregate the assets and liabilities in this case. So we are not concerned with the asset liability changes. But due to asset increase, depreciation is impacted. So what I need to do in this particular case, when you consider the share in post-acquisition profits, when you consider the share in the post-acquisition profits, that is when you apply the step number 2. When you apply the step number 2, changes in the post-acquisition changes. The net asset changes. So when you take the share in the post-acquisition profits, in this particular case, we'll reduce that additional depreciation from here. We'll reduce that additional depreciation in this case, because when the associate company earned a profits, that profit is without taking that additional depreciation. So you need to take that additional depreciation when you calculate the share in the post-acquisition profits in step 2. That's it. So indirectly, when you consider the step number 2, take care of that additional depreciations at that stage. Next, The next adjustment we did was on goodwill impairment, but in this case, there is no goodwill impairment. There will be investment impairment. Because goodwill, as we said, does not appear. Goodwill, as we said, does not appear as a separate line item in the balance sheet. It's a part of the carrying value of the investment. So I think if the investment is getting impaired, you need to decrease the investment and correspondingly the other equity. Simple and straight. So in this particular case, this is going to be adjusted, reduced from the investment and reduced from the other equity. Simple and straight. So these are the four typical adjustments. And finally, if there is any omissions, then I think the same logic applies. You can make an extract balance sheet and then proceed with the information if there is any kind of omissions. So the same 5 set of assumptions is what we are seeing in terms of equity method in a balance sheet. Just get the map clear. Let me just connect the dots. If there is any intercompany owing, simply ignored. If there is a stock reserve, depends it's down or up. So other equity reduction is common. If it is downstream, you reduce the investment, and if it is upstream, you reduce the stock. In terms of fair value adjustments, remember to reduce the additional depreciations when you take the share in post-acquisition profits. Investment impairment will be there, not goodwill impairment, reducing investment and other equity. And if there is any omissions, extract balance sheet. Most of the adjustments you can see is impacting the other equity, because if it is a one-line consolidation, just the investment appears and the corresponding other equity. So everything is indirectly getting adjusted in the other equity as well as investment. Right, friends? So I think this takes care of the inputs on the adjustments. Okay, now I'm getting some questions. So why, sir, other equity contains the whole amount of profit? Well, the other equity in the consolidated balance sheet is the investor's own equity. And when you would have applied the step number 2 on equity method, you would have also taken the share in the post-acquisition profits. So the other equity which appears in the consolidated balance sheet is a sum total of the investor's equity and the share of the investor in the associate post-acquisition. So whatever adjustments you're making is because you've taken the share in the post-acquisition profits as well. Right? I hope that answers your question. Sir, in stock reserve, why are we deducting other equity as the other equity of the investee does not contain the profit? Well, let's, I think, revisit this. When it is downstream in nature, now remember, what is the composition of other equity in the console? It's the investor's own other equity and the share in the post-acquisition. So there are 2 elements in the other equity of the console. One is the investor's own equity and one is the share in post-acquisition. Now, when it is downstream in nature, can I say this other equity of the investor includes that profit? Need to eliminate that. If it is upstream in nature, then the share in the post-acquisition profits got included in the other equity. The associate company made a profit and the share of the profit went to the investor. So this is a part of the other equity in any case. So since it is downstream or upstream, this other equity will definitely contain that profit. If it is downstream, it's a part of own equity of the investor. If it is upstream, it's a part of the share in the post-acquisition equity. So in any case, it is included in the other equity, whether it is down, whether it is up. So elimination from the other equity would happen. Right? I hope you got your answer on that. So can we deduct it from the investment? You mean to say that if it is supposed to be upstream? You see, there are 2 things. No. Not from the investment. You see, at the end of the day, if it is upstream in nature, the stock of the investor is included at a selling price. So this is going to appear in the consolidated balance sheet. How can you not touch the stock account? Visualize this part, that if it is upstream, It is a part of the stock of the investor, and the stock of the investor is appearing in the balance sheet. And if you don't touch the stock and reduce it, your stock is appearing at a selling price in the consolidated balance sheet. That would be technically incorrect, right? I hope that answers your question on that, Ayush. Okay, so then it says, so when it is upstream, it is 100%. No, no, no. In any case, this concept is equally applicable to this also and equally applicable to this also. The reduction in terms of the stock reserve will only be to the extent of share of the investor in the associate, whether it is upstream, whether it is downstream. Okay, that's perfect. Okay, you're most welcome. So I think this takes care of the adjustments. Now we're in a position to do some independent questions. Now, it's little too early to say something, but you know what? If you get a comprehensive question which is containing a subsidiary and an associate both, technically you will land up applying the 7-step model for the subsidiary and the associate independently, which means you get the date of acquisition and the percentages for the subsidiary associate. You do the analysis of equity of the subsidiary associate. You get the net assets of the subsidiary and associate. Then you calculate the investment for both the companies. Then you calculate the NCI for the subsidiary. Then you calculate the goodwill for the subsidiary and the associate. Then you make your other equity considering the post-acquisition profits in the subsidiary, in the associate, and then in the consolidated balance sheet, full consolidation for subsidiary, one-line consolidation for associate. Wow. You know, I will do a question of this sort today with you. And if time permits, then maybe in the last session, what I'm going to do, I'll do a comprehensive question which is going to consider all the facets with all the technical kind of adjustments on the subsidiary associate. But of course, that kind of question you may not confront in the exams ever. But let's see, this is, depending upon, if you get time, we might touch upon that. Let's see, that's a part of the planning at the back of the mind. We'll see that. Anyway, let's first begin with some independent questions on the application of equity method, just associate. So I am first going to take you to the study material, and there are some questions on the application of the equity method. So let's, I think, begin with, first of all, very simple and straightforward question. So I am going to first of all come to not a very simple question also, but I think let's do something little decent. So I am going to show you illustration number 10 in the study material. This is illustration 10 in the study material. So I'm just going to zoom this across to you. So let me first read the inputs. I'll work out the solution myself, but I've just retained the solution for the time being. We're going to apply a 2-step model. I hope this is visible enough. Let's read what is the inputs given in illustration number 10. It says Blue acquired 25% equity share capital of Green on the first day of the financial year at 125. On that date, the carrying value of the net assets is given and the fair value of the net assets is given. Now, if you recall in step number 1, I very clearly said you need to compare the share in the net assets on the date of acquisition at a fair value. So I'm not concerned with the carrying amount, I need the fair value. Then he says the excess of the fair value over the carrying amount is attributed to the building owned by Green, having a remaining life of 20 years. Green earned a profit of 40,000 and other comprehensive income of 10,000 during the year. Calculate the goodwill or capital reserve on the date of acquisition. Step 1. Blue share in the profits and other comprehensive income for the year, and then calculate the closing balance of the investment at the end of the year. So we're going to work out the 2 steps and analyze the inputs. Let's begin with the step number 1. So as an application, we start with the step number 1, which is on the date of acquisition. We compare the purchase consideration versus the share in net assets on date of acquisition at a fair value. So we will compare the share in the net assets on the date of acquisition at a fair value. Now we acquired 25% shares at 1,25,000. And if you compare the share in the net assets at a fair value, this is 4 lakhs is the net assets into 25% share, that is 1 lakh. So we get 25,000. That excess is what we call goodwill. And this goodwill is going to be a part of the carrying value of the investment and not a separate line item. That is done. So you can see the inputs here as well. This is what is done. This is what I call my step number 1. This is what I call my step number 1. Then we go to work upon the step number 2 in this particular case. Let's work upon the step number 2. The step number 2 is on the post-acquisition changes. The step number 2 is on a post-acquisition changes. So for which we'll take the investment as a base. For this, we will take the investment as a base, that is 125. Now, what we need to do, you will track the changes in the net assets. If it goes up, investment debit, share. It goes down, investment credit, share. So let's read the inputs. Now, first of all, it says the excess of the fair value over the book value is because of a building. So there is a difference between the book value of the assets and the fair value of the net assets. The book value of the asset is 3 lakh and the fair value is 4 lakh. So that increase of 1 lakh is attributed to the fair value adjustments that is building. And that is a part of my sheet. So I said if there is a fair value adjustments, there is a need to consider additional depreciation when you consider the post-acquisition profits. So we'll take care of that. So we can say that if you look at the increase in the fair value compared to book value is 1 lakh. And if you calculate the depreciation, the remaining life is 20 years. If the remaining life is 20 years, we can say 5,000 is supposed to be the additional depreciation, which will take care from the post-acquisition earnings. Then he says they earned a profit of 40 in the P&L and 10,000 in the OCI. So let's work out what is the post-acquisition profits. So there is a post-acquisition profits. Now there are 2 sections in which the profit is earned. One is in the P&L and one is in the OCI. Now to give you a complete set of entry, when the associate earned a profit in the P&L, my entry is investment debit, mirror accounting, P&L gets a credit. When the associate earned a profit in the OCI, so I do a mirror accounting, investment debit, OCI credit. So in both the cases, investment gets a debit and P&L gets a credit and OCI gets a credit. So the investor will put an entry in the consolidated financial statements when he earns a profit in the P&L, investment debit, P&L credit. When he earns the profit in OCI, investment debit, OCI gets a credit. Now, the profits earned in the P&L is supposed to be 40,000. But what we need to do from this 40,000, we need to reduce the additional depreciation and then consider his share. As we said, the additional depreciation needs to be reduced from the post-acquisition earnings. So before you take the share, you can take 40 minus that additional depreciation and then the share. OCI earning is to the extent of 10,000. So on this 10,000, we take a 25% share. That's 2,500. And this is 35,000 into 25%. That's 8,750. So with this, we can get the investment value. So if we add all these up, 136,250 is the investment value. And I think we can have a look out here. So this is the value of the investment, 136,250, which I have computed. So this is as simple and straight. So I think if you go on a step-by-step basis, applying the equity method, you cannot go wrong. So only thing which was there in this particular case is just one additional depreciation adjustment. That's it. There's no investment impairment. There's no stock reserves, nothing. Absolutely a plain vanilla question. Okay, so this was pretty simple and straight. Illustration number 10. I guess now let's consider one more question. Then we come to another interesting case. There is an illustration 12 in the study material. That's a wonderful illustration. I think it's come in the exams also, if I rightly remember, but we'll come back to this later. I've just added a few questions of my own as well, and I think we can have a look at those questions before we come back. So let me just, I think, first share a few questions to you. Yes, we can now go for a question which is January 21 examination question. So let's consider the question on January 21 examination question. Let's have a look at this question.
So where will we get this PDF?
You can download it from the LMS which is there. I upload this after the end of every session.
Okay, sir. Thank you.
You're welcome. Okay, so let's, I think, read the inputs which are given. This is January 21 examination question. Though it was just 5 marks, but I think it's a good question to understand the application of equity method again. So let's, I think, first of all, read the inputs which are given out here. It says on 1st April 19, BIG acquired a 35% shares in DIG and achieved a significant influence. The cost of the investment is 3 lakhs. DIG has a net assets of 5 lakh 50 on 1st April, but the fair value of those net assets is 650. So this is the book value and this is the fair value. Since the fair value of the PPE is 1 lakh higher than the book value, this PPE has a remaining life of 8 years, similar kind of adjustments. Then he says for the financial year 1920, which is post-acquisition, DIG earned a profit after tax and it paid a dividends of 11,000 out of these profits. DIG has also recognized a loss of 15,000 that arose from the remeasurement of defined benefit directly in OCI. So some profits are earned in the P&L and some profits are earned in the OCI. Rather, I would say the loss is earned in the OCI. Calculate the BIG Limited interest in DIG at the end 31st March 2020 under the relevant method. Relevant method, of course, means the equity method of consolidation. So we're going to apply the 2 steps again. Let's begin the journey. So we're going to first of all apply the step number 1, which is on the date of acquisition. So I'll compare the purchase consideration versus the share in net assets that is on the date of acquisition at a fair value and get the results. So I think if I look at the purchase consideration, we acquired the investment at 3 lakhs. And if you look at the net assets, the book value is 550, but we need the fair value. So 6 lakh 50, and we've got a 35% stake in the company. So we get the share in the net assets at a fair value. Simple and straight. So this is going to be 6 lakh 50 into 35%, 227,500. So this difference is the goodwill, which is a part of the carrying value of the investment. That's 72,500. And that's done. Step 1, absolutely simple and straight indeed. Now let's go to the step number 2, which is post-acquisition changes. So we go to the step number 2, which is the post-acquisition changes. So in terms of the post-acquisition changes, we'll take the investment as a base. 3 lakh is the investment, which is a base. Now let's come back. So there is definitely a fair value increase resulting in additional depreciation, which is to be taken care when you consider the post-acquisition earnings. So I think now we are given that in 1920, they earned a profit after tax 1 lakh, and then they paid a dividend of 11,000 out of those profits. Now let's visualize. When the associate company earned a profit, the net assets went up. But at the same time, when they paid a dividends, the net asset goes down. So either you can treat the earnings as one transaction, the dividends payment as another transaction, or you can just consider what is the profits in retained, the share in the retained earnings. So when they earned a profit, the net assets went down. When they paid a dividend, the net assets came down. So what I'll do in this case, I'll take the share in post-acquisition profits. I'll take the share in the post-acquisition profits, again in the P&L and again in the OCI. So when I take the share in the post-acquisition profits in terms of P&L, so I'll consider 1 lakh minus 11,000. So we'll take the profits as 1 lakh minus 11,000 and minus the additional depreciation as well. So we're taking the share in the retained profits. 1 lakh was earned, 11 was paid, so 89. And then there is an additional depreciation. So 1 lakh is the increase compared to the book value. Life is 8 years. So 1 lakh divided by 8, it is 12,500 additional depreciation. So this into 35%. And then it also says that DIG earned a loss on account of remeasurement of defined benefits directly taken in OCI. So there is a loss in the OCI. A loss in the OCI would mean the net assets will go down, investments will go down. So we'll take the share in the loss, that is 15 into 35%. That will reduce the investment value. So 1 lakh minus 11,000 minus 12,500 into 35%. This is 26,775. And a loss of 15 into 35%, this will be minus 5,250. So this will give us the investment value. 3 lakhs plus 26,775 minus 5,250. This is going to be 351,525. 321. This is going to be 321,525. Let me just write it properly. This is 321. This is 321,525. That is the value of the investment. Pretty simple and pretty straight indeed. I think these two illustrations would have given you some basic feel of how the equity method of application is done. I'm sure you would be feeling confident, correct? Okay, let's, I think, do another question with you before we complicate this further. Let's consider one of the questions which came in RTP in November 2020. So let's take another question that is in the RTP in November 2020. Let's read. I think this time I'll take your help. It says on 1st April, investor acquires 35% interest in another entity, and the investor determines that is able to exercise a significant influence over XYZ, and he paid a total consideration 4750. At the date of acquisition, the book value of the net assets is given 90 lakhs and the fair value is given it's 110 lakhs. The difference of 20 lakhs pertains to item or PPE which has got a remaining life of 10 years, resulting in additional depreciation. Then he says during the year it made a profit of 8 lakhs. Then it paid a dividends which is 12 lakh. Then he says it has also got a long-term investments in equity securities. Under Ind AS, investment is classified as fair value through OCI in accordance with 109, and they took the increase in the value of 2 lakhs in OCI, ignored deferred tax implications. calculate the closing balance of the investor's investment on March 2020. I think let's do it faster. This is absolutely similar to the question which came in the exams January 21, and this was in RTP November 2020. I hope you got the trail. It came in the RTP in November 2020. A similar kind of question came in January 21 in the exams. So doing RTPs is also very, very crucial indeed. Okay, so I think let's work this out. Let's go to the step number 1.
So nowadays the RTP questions are not coming.
That's, not something which we can consider as a trend. But I think we should definitely do them as an extra practice, I would say. Okay, now let's, I think, consider the step number 1. So what is my purchase consideration? 47.5 lakhs. Would you like to tell me? I compare this with what?
110.
That's right. The fair value, that's 110 into 35% stake. Let's see what is the goodwill in this case. So 110 into 35% compared to this, I think it's 9 lakhs, right? So this is step 1. Now let's go to the step number 2, which is the post-acquisition changes. And we take the investment as a base. Now we need the share in the post-acquisition profits. So one is in the P&L and one is in the OCI. Let's ask you, what is the share in the P&L? You tell me. So give me the figure, this plus this minus this, whatever. So what do we take the share in the post-acquisition P&L? Can I say this is going to be 8 lakhs? That is the profits earned minus the dividends which is paid. This is, I think, seems to be a little misprint. The profit should be 80 lakhs, not 8. So this is going to be 80 lakhs. So we'll take 80 lakhs minus the dividend paid is 12. Anything else to be reduced from the profits? Additional depreciation, right? Can I say the additional depreciation will be what? 20 lakhs and the remaining life is 10 years. So 2 lakh is the depreciation. And we consider 35% share. So 80 minus 14 into 35%. That's, I think, 23.1 lakh. And as far as OCI is concerned, it's a gain of 2 lakhs. So can I say on this gain of 2 lakhs, we take a 35% share, that is 0.7 lakh. I think that will give us the investment value, simple and straight. 47.5, 23.1 and 0.7, 71.3 lakhs is the value of the investment. Right, friends, I think so far so good. I think you would have got a basic essence, a feel of how the equity method is done. Comfortable?
Yes, sir.
Wonderful indeed. Okay, now let's come back to the illustration in the study material. Illustration 12 is what we're going to do now. This question is there in the education material also, issued by the Accounting Standard Board. It's there in the study material as well. And I think it's come in the exams also quite in the recent. So it's a very simple question, but I think it throws a good light on the mirror accounting. I would say it's a good question on the concept of mirror accounting. Let's read the inputs which are given in this question. This is illustration 12 of the study. It says A has got a 20%. A has got a 20% equity interest in B in associate, and that in turn has got a 100% equity in C. Now let's visualize. I'm given a chain A in B and A in C. This is the chain holding which is given. It says A has got a 20% stake in B, and B in turn has got a 100% stake in C. So I think we can clearly see that A has got a significant influence over B, and B's got a control over C. Now let's further see. It says entity B recognized the net assets relating to entity C 1000. So what B has done, it recognized the net assets 1000 in the consolidated financial statements. So we can see in B's consolidated financials, he's taken the assets of C and there is a corresponding equity. That's it. This is the consolidated financials of B. So it says B recognized the net assets relating to C in the consolidated financials. Then he says B sells 20% interest in C to a third party. It takes me back to Index 110. Can I say if B made a 20% stake sold, does it lead to loss of control, or is there going to be no loss of control? 100, 20% sold, 80.
No loss.
That's right. So there is no loss of control. So would you like to give me a journal entry which B Limited will pass when there is a changes in the ownership interest? 103 reversal entry or the entry pertaining to NCI debit bank credit? Can I see the entry will be
NCI.
NCI gets debit? That's right. And bank gets a credit. Wonderful indeed. Now, it says B sells 20% interest for 300 and recognizes this transaction as an equity transaction in accordance with para number 23 of 110, resulting in a credit of B's equity 100. So NCI would get a debit to what extent? Can I say bank gets a credit of 300? Sorry, I'm putting the reverse entry. It should be bank debit, NCI credit, I'm afraid. So the entry would be bank gets a debit and the NCI gets a credit. So can I say bank gets a debit to the extent of 300, NCI will get a credit. Can I say out of this 1000, 20% belongs to the NCI? And since in this particular case, it's a transaction between the equity shareholders, we decided the gain or loss is captured in the equity. So the balancing figure in this case, that is 100, is taken in equity. So he's just explaining the transaction that when they sold the stake 20% for 300, it was an equity transaction resulting in increase in equity 100. Okay. Now let's also have the consolidated financial statements of A. So what A has done, he has applied the equity method, the net assets of the company B. He's taken a 20% stake because he's got a 20% stake. So you can see the investment appears in the balance sheet and the equity appears in the balance sheet. Now, before we read further, let me ask you something. When the entity B made a sale of investment, his equity would increase from 1000 to 1100. And the increase in equity means that there is an increase in the net assets. So can I say I should also increase the investment? And where should the corresponding credit go? The change in the net asset led to a credit in equity by the company B. So is A also going to give a credit to equity directly? What do you say? If it is a case of mirror accounting, do you think it makes sense? Okay, I'm here to get answer on that. So the answer, of course, is a big yes. If B Limited equity or the net assets went up and there was a credit directly to SOKI, then even A Limited is going to give a direct credit to SOKI. That's mirror accounting. Let's see further. It says the financial statements of B after the transaction is given. So this 100 is the profit on sale of the equity. So that becomes 1100. And the NCI now appears at 20%. And the assets were 1000 and the cash is received on the sale. So this is the consolidated financial statements of B after he sold a 20% stake in C company. But this led to an increase in the equity of the associate company. So the associate company did not earn a profit in the P&L. The associate company did not earn a profit in the OCI, but the associate company made a transaction in which the equity went up. And therefore, I would also put the entry investment debit to the extent of share in that 100, that is 20, and the corresponding credit will be mirror accounting. Since he credited equity, I will also credit equity as an investor. So although A did not participate in the transaction, the entity's A share of net assets in B is now 20% in C. Effectively, A share in net assets is now 220, 20% of 1100, that is 20 in addition to the previous share. How is an equity transaction recognized in the financial statements of B reflected in the consolidated financials of A that uses the equity method to account for investment? So I would say the entry which A is going to pass, that is investment gets a debit and the equity gets a credit, and he will put this entry at 20. We'll still read, but that's the result. The changes in the interest on the net assets of the associate as a result of investee's equity transactions is reflected in the investor's financial statements as a share of changes in equity. It says it'll enter in the SOKI instead of again in the statement of P&L. Since it reflects a changes in the net assets and faithfully reflects the investor share as presented, it says as presented in the associate console. Thus, in the given case, A recognizes 20 as a change in other equity instead of P&L, maintaining the same classification as the associate. That is a direct credit to the equity in the consolidated financials. As I said, this illustration throws a very important light on what I always say is a case of a mirror accounting. Because there are two things as a part of my step number 2. When the net asset goes up, investment debit. When the net asset goes down, investment credit. And the corresponding credits or debits is always a mirror accounting. If the associate gives a credit to the P&L, the investor gives a credit to P&L. He gives a credit to OCI. He gives a credit to OCI. He credits the equity directly. As we can see in this question, he also gives a credit to equity directly. So I think it's a wonderful example on the mirror accounting phase. I hope, friends, I stand very clear on my thoughts. Okay, so this was illustration number 12. This is done. So the aspect of block number 2, that is equity method of consolidation, is done, not from the P&L point of view, but from the balance sheet perspective. Now comes the agenda. How do you tackle this in terms of consolidated income statement? So I think before we go to a larger question, looking at a balance sheet and looking at a P&L with associate and with a subsidiary, I think we can first also consider P&L. So do you want me to make a comparative chart right now, including the P&L aspect of associate, where we get a subsidiary, where we get an associate? How is the 5 adjustments done in a balance sheet? How are they done in a P&L? All the 4 permutations, combinations. You ask me, I give it to you. You don't ask me, I don't give it to you. So I get a yes on that. Okay, so I think we'll definitely give this to you. Let's make a comprehensive chart. Then I think we'll do questions on the area. One on the consolidated balance sheet with an associate, one with a consolidated income statement with an associate, and I think that will give us a good edge in terms of block number 2. Let's now make an interesting mind map. So we are going to make a good summary sheet considering all the 5 adjustments, how they're going to be tackled in terms of balance sheet and in terms of P&L. So I think let's divide this in 2 blocks first of all. And we divide this further in sub 2 blocks. So I'm looking at all the permutations combination. So this is a summary chart. This is a summary chart which is going to give you all the adjustments And we're looking at the adjustments from the point of view of subsidiary and associate. So first, let's take subsidiary and let's take associate. And in this particular case, we're looking at consolidated balance sheet and consolidated P&L, consolidated balance sheet, and consolidated P&L. So all the permutations, combinations. So I think let me just make the inputs 5 blocks as well. The space may not become a constraint. So 3 and 5. So we've got 5 adjustments in this case. So we're looking at intercompany owings. We're looking at intercompany owings. Now, in the balance sheet, for an associate, I'm considering that let's say you get a comprehensive question and you have to make a run through of all the 7 steps. So I think I'm going to visualize what is to be done in the 7 steps. I think that's a better deal. That's going to be a better deal in this case. So intercompany owings, then stock reserve, if it is down and upstream. Then we're going to look at the fair value adjustments. Then we're going to look at the goodwill or investment impairment. Goodwill or investment impairment in which there is full and partial goodwill. So putting it as F and P. And then I'm looking at any kind of omissions. Typically, the omissions I'm looking at is the omission of DC, deferred consideration. Okay, so I think let's begin the journey. I'm just going to put things. If you want, you can give your answers in between as well, if you're comfortable. Otherwise, I'm going to just fill the chart. If you've got any concerns, you can stop me there and then. Let's begin the journey. So in terms of intercompany owings for a subsidiary, we took the impact in step number 7. I think that's the easiest. So let me fill this up first. So we will look at the 7-step model and identify the areas which this adjustments are done. Now, let's put the questions to you. If it is a stock reserve downstream in nature, then which step numbers? Downstream. So step number 2A and step number 7, right? This is going to be downstream. No, not step number 2A. That was upstream. Downstream is step number 6 and 7. Downstream is going to be step number 6 and step number 7. Upstream is supposed to be step number 2A and step number 7. So upstream was 2A and 7, downstream is 6 and 7. Okay, let's consider the fair value adjustments. Where do you consider the fair value adjustments? Because if I fill the entire chart, there's no fun. So where do you take the fair value adjustments? Step number
2A and 7.
Wonderful indeed. Step number 2A and step number 7. Great. And what about the goodwill impairment, if it is full or it is partial?
Full 4, 5, and 6.
Very good. So step number 4, 5, as well as 6. And if it is partial?
5 and 6.
5 and 6. That's wonderful indeed. So this is on the consolidated balance sheet. And omissions, this will be extract balance sheet. This is what you're going to do, is the extract balance sheet. Now let's focus on the consolidated balance sheet of associate first. So here I'm considering that you are going to follow the 7-step model. So let me tell you one thing. In terms of the associate company, I will add a step number 5A. If you get a comprehensive question where I have to do the analysis of the equity as well, you get a complete balance sheet of the associate. So what I'm going to do in the step number 7-step model, I'll add a new step, and this is to calculate the investment in associate company. So I'm going to add a step number 5A in the 7-step model. Now we'll visualize these adjustments that they should be taken in which step. So let's begin with the first one, intercompany owing, step number. Intercompany owing, step number, ignored. It's not taken because we do not consider this. That's right. It's going to be not applicable. Okay, stock reserve, if it is downstream and if it is upstream, now I'll tell you. Well, my advice is that if it is downstream or upstream, in any case, it is going to hit the investment or the stock and the other equities. So my input is that if it is downstream in nature, in this particular case, you can take care in terms of step number 6. And if it is downstream, you can take care in step number 5, investment. Rather, I would say 5A. So if it is downstream in nature, what you can do, you can eliminate from the investment, step 5A, and you can eliminate from the other equity. And if it is upstream, then it is step number 6, and in step number 7 from the figure of stock. So if you get a comprehensive question, remember in which steps you're going to consider. So you need to reduce the investment other equity, 5A and 6. If it is upstream, then it is step number 6 and 7. Let's go to the fair value adjustments. So in terms of the fair value adjustments, what do? You're going to make the changes. You're going to make the analysis of other equity as well. So you could take this in terms of step number, you can say 2A, and the additional depreciation in terms of step number 5A. I know this might sound crazy at this stage. In step number 2A, when you do the analysis, you take care of the fair value changes. You take care of the fair value changes in that particular case. And you will take care of the additional depreciation as well. So I would say step number 5A will automatically get taken care. Because when you take the post-acquisition share, I think it will automatically get taken care. So just in step number 2A in the analysis, the fair value change and the additional depreciations will automatically taken care. Then there is investment impairment. There is no goodwill impairment. Here there is going to be investment impairment. Any guess which step are you going to consider this? Guess. There is no partial, there is no full goodwill. So which step do you think this will impact? Investment equity. Which step? Investment, you know the new step. Step number 5A and 6. So we're going to take this in step number 5A and in terms of sticks. And if there is any omissions, you can take care of this again in the extract balance sheet. That is similar. So this is on the consolidated balance sheet for an associate. If you apply a 7-step model in a larger question, where do you tackle these inputs? Now let's come to the consolidated profit and loss. Can I say intercompany owings not applicable? And stock reserve, whether it is down or upstream. Now, can I say minus from the sale, minus from the cost of sale, and plus the stock reserve and the cost of sale, down, upstream, whatever. So what I'm going to do in this particular case, from the figure of sales, minus the sales, from the cost of sales, minus the sales, and add the stock reserve in this case. I'm not talking about the NCI share in profits. That can be seen later. So from the sales and the cost of sale, eliminate the sales, and to the cost of sale, add the stock reserve. Fair value adjustments, you need to increase the depreciation in the profit and loss. Goodwill impairment, you need to record the goodwill impairment. As an expense, you will record the goodwill impairment as an expense. So depreciation will increase, goodwill impairment will be recorded. And in this particular case, you'll have to increase the finance charge if there is an omission of a deferred consideration. Right, so this is on the consolidated P&L, that is subsidiary. Now let's talk in terms of associate. There is no aggregation of income and expense, just one line consolidation, share in post-acquisition profits. So let's talk in terms of the intercompany owings in the P&L, no impact. Now, in terms of the stock reserve, if it is consolidated P&L, now we need to be careful. Can I say if it is downstream, then in that particular case, if it is downstream from the cost of sales, you will add the stock reserve. Because the sale is made by the investor. So what I'll do in this particular case, I will add the stock reserve to the cost of sales in this case. And if it is downstream, when I take the upstream, when I take the post-acquisition profits, from the post-acquisition profits, I'll reduce the stock reserve. So if it is going to be downstream, I'll add it to the cost of sales. And if it is upstream, then in this particular case, the associate made a profits. So when you take the post-acquisition profits, I'll reduce the stock reserve at that stage. Fair value adjustments, when we take the post-acquisition profits, we can reduce the additional depreciations from that post-acquisition profits. That's what we've seen earlier as well. And if it is supposed to be investment impairment, here again, when you consider the post-acquisition profits, when you take the share in the post-acquisition profits, reduce the investment impairment at this stage. And if there is any omissions, then you can take care, increase the finance charge of the investor in the consolidated P&L as well. So I know most of the adjustments we have not seen in the P&L, so it's a little difficult to visualize, but I think I wanted to pen this down at a single place, all the inputs. So I think let's do one thing now. Let's do two questions with you. One question on a consolidated balance sheet, subsidy with associate. One question on a consolidated P&L, subsidy associate, so that all these adjustments which you can see is going to be crystal clear in the mind. Let's begin the journey. Okay, so let me share a question from my side on this area. I am going to share two questions with you. One is on the balance sheet, one is on the P&L. Yes, I think let's have a look at a question. First of all, on a balance sheet. I'm added a question from my side, not very complicated, but at the same time is going to give you a complete feel of how things will be done. So I've just added a question from my side, associate and subsidiary put together. So let's begin. This is on a consolidated balance sheet. Then we'll do a question on the consolidated income statement that will close the concept of Ind AS 28. But then there is another third block as well. And there is one pending issue on the block one, that is on the scope. The third block is on the other long-term interest, and scope is also slightly pending. But otherwise, the block number 2 gets completed after this. Let's begin. It says the financial statements for 3 entities for the year ended 30th June X8 is given. I'm given the balance sheet of B, H, and S. Then it says in the additional information that on 1st July X7, that's the beginning of the year, B purchased 45,000 shares in high for 1 lakh. And on that date, the retained earnings is given 30,000 and no other components of equity. The net assets had a fair value. It says 1,20,000 and the fair value of the NCI is given. It is a group policy to value the NCI on the acquisition date at a fair value. So we're given the status at the beginning of the year, that at the beginning of the year there has been some retained earnings, and we are also given the net assets had a fair value of 1,20,000. Okay, let's proceed further. Then he says the excess of the fair value of the net assets over the carrying amount relates to the PPE. The PPE had a remaining life of 5 years. Then goodwill is subject to an impairment and is impaired by 7,000. Now, since NCI is at a fair value, the goodwill is supposed to be full. And if the goodwill is full, then the step number 4, 5, 6. Then he says on 1st July, B purchased 10,500 equity shares in Street for 21,000 and the retained earnings on that date is given. So B has got two investments. One is in a subsidiary, one is an associate. Then he says during the year, B sold goods to H. So B purchased the goods in H. So B sold goods to H would mean that it's downstream in nature. It says at a margin of 50%. And then it says by the reporting date, it sold 80% of the goods. So 20% is still unsold. Included in the receivables of B and the liabilities of H are intergroup balances of 5,000. So this is an intercompany owings. This is a fair value adjustments and goodwill impairments. Then he says on 5th July, B received a notification that an employee is claiming damages against them as a result of workplace accident that took place on 30th April before the balance sheet date. So you received a notification on the 5th of July, and this is on account of accident which took place before the balance sheet date. Lawyers advise that there is a 60% chance that B will lose the case and they will be required to pay a damages of 30,000. What is this point indicating? This is something relating to the parent company. Somebody filed a case against the company, accident took place before the balance sheet date, and then there has been a claim against the company. Are we applying Ind AS 10? Are we applying Ind AS 37? Are we saying that there is a condition on the balance sheet date and there is evidence which is arising post the balance sheet date resulting in an adjusting event and making a provision in the books of accounts? What do you say? Is my thought correct? Yes. So we're required to make a consolidated balance sheet on 30th June X8. Wow. So moral of the story now. So now we are going to do this question by running all the 7 steps, including that step number 5A, which I added because you get the balance sheet of the associate as well. So we are going to run all the 7 steps comprehensively. Okay, let's begin the journey. So what is the first thing I am going to do in the question? Extract balance sheet. In the last para, we're given the events after the reporting period resulting in a condition on the balance sheet date and resulting in creating a provision as per Ind AS 37. So the first thing we're going to do is extract balance sheet. So I think I'll just quickly run the facts since you might be looking at the question for the first time. Just get the basic facts clear before we start. The balance sheet of 3 companies given, B, H, and S. B is the parent, H is the subsidiary, S is the associate. So we're given the inputs that B purchased shares in H. The retained earnings on that date is given. The net assets at a fair value is given. NCI is at a fair value. That's one input. Then I'm given the fair value changes, the goodwill impairment. Then B also purchased shares in the associate company. The retained earnings on that date is given. Then there has been a downstream stock reserve transaction, some intercompany balances. And the last information is on omissions made by the parent company for a claim against them. So we have first taken care of the extract balance sheet. So let's begin with, first of all, the extract balance sheet. So in this particular case, as we make the extract balance sheet, let's visualize what will be the impact of this omission in the balance sheet. One is you need to create a provision in the books that's going to be a current liability, ideally payable within a year. And the second is we need to take a hit on the retained earnings. So let's go back. So it says B received a notification and there is a payment required 30,000. So let's see what is the retained earnings of B. The retained earnings of B is 2 lakhs. So I will make the changes in the balance sheet. So let's make the changes on the equity and liability side. So on the equity side, we need to make the changes in the retained earnings. The retained earnings are 2 lakh, reduce this 30,000. So the new retained earnings is 170. And we make the changes on the current liability. we create a provision for the claim, and the provision for the claim is supposed to be 30,000. So indirectly, if you ask me the journal entry in this case is RE gets a debit and the provision for the claim gets a credit. So we've done the extract balance sheet. These are the changes in the balance sheet of B. That is supposed to be the parent company. So before we proceed, this is the impact of the omission. Now, what we're going to do, as we're going to go to the steps, as I said, it's a comprehensive question. So you need to work out every step for the subsidiary and associate. So on the date of acquisition, get both. Analysis for both. Net assets for both. Then the PC for both. The goodwill for both, NCI only for the subsidiary, then consolidated balance sheet, other equity, post-acquisition profits for both. And then we're going to make a consolidated balance sheet, subsidiary full, and associate one-line consolidation. So let's begin with the step number 1. That is getting the date of acquisition and the percentage in this case. So let's organize the data. So we're looking at B acquired shares in H and B acquired shares in S. This is subsidiary and this is associate. So B is the parent, H is the subsidiary, S is the associate in this case. So let's see what is the date of acquisition and the percentage. So we get the date of acquisition and the percentage. Let's go back. So I'm given on 1st July X7, B purchased 45,000 shares and the total shares are 75. So let's see the percentage. 45 divided by 75, it is 60%. So date of acquisition is 1st July X7 and the percentage is 60% in the subsidiary. Let's go back. Now, in terms of the other company, that is associate, again, the shares are required on 1st July. We purchased 10,500 shares and the total shares are 35,000. So 10,500 divided by 35, it's 30% stake. So this is 30% stake and this is also on 1st July X7. So we just identified the date of acquisition and the percentages in both the subsidiary and in the associate. Okay, now let's proceed with the step number 2A. So we need to do two analyses. So we'll organize the information because we need two analyses in this case. So let's organize the two analyses of profit. So we need the analysis of other equity. One is for the subsidiary company and one is for the associate company. And split this in terms of pre and post. Split this in terms of pre and post. So let's begin with the analysis of other equity. So we define the pre-acquisition. This is going to be pre-1st July X7 and this is going to be post-acquisition from 1st July till 30th June and this is also pre-acquisition. This is pre-1st of July and we get post-acquisition and that is 1st of July till 30th June. So we first define what is pre and what is post-acquisition. So we've defined it absolutely clear and crystal. The date of acquisition becomes the base for pre and the remaining is post. So we keep the same focus points and we have those three focus points. You're going to look at the balance sheet of the subsidiary. Then you're going to look at the additional information for fair value adjustments and you're going to look at the additional information for stock reserve, which is upstream in nature. So let's begin the inputs. So let's go back and let's see the analysis of other equity. Let's first focus on the subsidiary. So the subsidiary has got retained earnings and other components of equity. So we've got two components in other equity. One is retained earnings and the other is the other components. It says on the date of acquisition, the retained earnings are 30 and there is no other components of equity. Let's concentrate on this part only. So let's begin with, first of all, the retained earnings. Let's make a timeline. So we know the retained earnings at the beginning is 30 and the retained earnings at the end is 50. I'll just catch the figures once again, lest we go wrong. Yes, the retained earnings is 30 on the acquisition date and it is 50 on the balance sheet date. So can I say this 30 is pre and the increase of 20 is post under a separate head? Under a separate head, let's create retained earnings as a separate head. So the balance on the date of acquisition is pre and the increase is post. So 30 is pre and 20 becomes post acquisition. Then we consider the other components as well. And again, let's consider a timeline. The other components on the beginning of the year acquisition date was nil, but at the end of the year is 5. So we can see that pre-acquisition is 0 and post-acquisition 5,000, creating another sub-column. Creating another sub-column in this case, because when you're considering the other components, we'll add line-to-line addition. So retained earnings, separate column, other components, separate column. So I think the balance sheet other equity is taken care. Next, once this is done, let's go to the fair value adjustments. So now let's work on the fair value adjustments in this case. So for the fair value adjustments, we go back to the additional information. So it says the net assets at a fair value is 1,20,000. The net assets at a fair value, it says, is 1,20,000. Now we can do a small little calculations at this stage to get the data. The equity share capital of the subsidiary was 75 on acquisition date and the retained earnings was 30 and there was no other components of equity. So if I were to calculate what is the net assets at a book value on date of acquisition, if I were to calculate the net assets at book value on the date of acquisition, I can conveniently say you take this 75 plus 30, I would say this is 1,05,000. Please watch the calculations carefully. This is the equity share capital and this is the retained earnings on the date of acquisition. So if you calculate the net assets on acquisition date at a book value, it is 1,05,000. And it says the net assets had a fair value. The net assets at a fair value on the date of acquisition is supposed to be 1,20,000. So we can conveniently say that there is a 15,000, you can say fair value increase. So there is a fair value increase to the extent of 15,000. So once we compare the net assets at a book value versus the net assets at a fair value, we will be able to get the fair value adjustments. Let's read further. The excess of the fair value, that is 15,000, which we calculated, relates to PPE, and this has got a remaining life of 5 years on the date of acquisition. So we know what is the fair value increase, 15, and then 5 years spread the depreciation. So let's go back to the analysis on the fair value adjustments. So we know that PPE stands increased by 15,000, that is pre-acquisition. And we take care of the additional depreciation. 5 years is the life. So we need to consider the additional depreciation, that is 3,000. 15,000 divided by 5, we get an additional depreciations as well. Right, and I think the stock reserve which is given in the question is downstream in nature, so that will not be taken care in this step. That's it. So we can get the pre and the post acquisition movements in this case. So this is going to be 45,000. and this is 17,000, and this is 5,000. So this takes care of the analysis of the equity as far as subsidiary company is concerned. Absolutely in a similar manner, whatever we do, the three focus points, the same three focus points are here as well. Now let's go to the associate company. Again, we repeat this entire inputs. Now for the associate company, we can see that there is a retained earnings, but there is no other components of equity, just a retained earnings of 40 in the balance sheet. And I'm given out here, it says on 1st of July, B purchased goods in S when the retained earnings is 25 and there is no other components of equity. So on the acquisition date, the balance is 25. On the balance sheet date, it is 40. So let's get back to the retained earnings. Let's make a timeline. The balance on the date of acquisition is 25. The balance at the end of the year is 40. So we can easily get 25, the balance on acquisition date is pre, and the increase is post-acquisition in nature. Wow. So this is done. There are no fair value adjustments given for the associate, and there is no stock reserve given for the associate as well. There is only analysis in the balance sheet. That's it. Let's begin. So let's take the sum total of the pre and post in this case. So this works out at 25,000 and this works out at 15,000. So this is the step number 2A, analysis of the subsidiary and the analysis of the associate. Now we go to the step number 2B, getting the net assets on acquisition date. Now let's go to the step number 2B. So in terms of step number 2B, we need the net assets on date of acquisition at fair value. We need the net assets on date of acquisition at a fair value. So keep doing the two calculations, the subsidiary and associate. So let's make two calculations again. One is for the subsidiary and one is for the associate. So we need the sum total of the equity share capital and the other equity that is pre-acquisition in nature. So all the data is available. We just need to pick up this from the step number 2A and the share capital from the balance sheet. So let's go back to the balance sheet. So equity share capital is 75 and 35. Equity share capital is 75 and this is 35. And the pre-acquisition equity, that's going to be 45 and 25. So this is 45 and this is 25. So this is 60. And this is supposed to be 120. And this 120 is already given in the question. Though it is already given in the question, but I think we still need to work it out because additional depreciations are required. So this is the net assets at a fair value for the subsidiary as well as for the associate company. Then we go to the step number 3. And in step number 3, we need the purchase consideration, that is investments. It's, like two subsidiaries in the question, but one is an associate and one is a subsidiary. But indirectly, the workings are like, you've got two subsidiaries. Now, similarly, for the purchase consideration, we need what is the purchase consideration for the subsidiary as well as for the associate company. Let's get back again on the additional information. So we can see that investments are appearing in the balance sheet at 121. Now the focus would also be to see that does this 121 include some outside investments or not? So that we'll see. So he purchased the shares in the subsidiary at 1 lakh out of that 121. And he purchased the shares at 21,000. So there is no outside investments. So this investment is purchased at 1 lakh. This investment is purchased at 21. And if you look at the total investments this comes to 121. So if you look at the total investments, this comes to 121. And if you look at the investment in the balance sheet of the parent company, that is also 121. This is indicative that there is no outside investment. So there is no other investment. I think that is also an important conclusion. Because when you're looking at the step number 3, getting the outside investment is important because those will appear in the consolidated balance sheet. So we've also identified that there is no other outside investments in this case. Okay, step number 3 is done. Then we go to step number 4. Then we go to the step number 4, and step number 4 is the calculation of the NCI. Now, this is required only for the subsidiary because in terms of associate, we do not calculate any NCI. So we are going to take the NCI on date of acquisition, and that's already given in the question at a fair value. And to this, we add share in post-acquisition profits. To this, we add the share in the post-acquisition profits. And anything else which needs to be taken? Any focus point on the NCI? So let's pick up the NCI on the date of acquisition. Is it a fair value? Yes. So NCI is 55 and there is a goodwill impairment 7. So NCI on the date of acquisition is 55,000. And then we also need to consider the goodwill impairment because goodwill is full goodwill. So the NCI will bear the share. So out of that 7,000, 40% belongs to the NCI. That's 2,800. And let's consider the post-acquisition profits as well in the analysis. 17 and 5. The post-acquisition profits are 17,000 in the retained earnings, 5,000 in the other components. 40% of this belongs to the NCI. Yes, goodwill impairment, that was correctly said. So this is 8,800. So this will give us the status of the NCI. 55 plus 88 minus 28, 61,000 is the NCI. So that is the step number 4. Now comes the step 5, that is on the goodwill. We need 2 goodwills now, subsidiary and for the associate. So let's go to the step number 5. So step number 5, we need goodwill or the bargain purchase gain. This is going to be calculated for both the companies. And one thing which I like to pinpoint at this stage, the way a goodwill is calculated for a subsidiary and the way the goodwill is calculated for the associate is different. Because when you calculate a goodwill for the subsidiary, you take PC plus NCI and compare it with the net assets. But when you calculate the goodwill for an associate company, you compare the PC with share in net assets. There is no NCI role in terms of associates. So 2 different formats. So we've got subsidiary and we've got associate. So for the subsidiary, we'll take the purchase consideration, add the NCI, compare it with the net assets, and we're going to get the goodwill. Then we also need to reduce the impairment of goodwill. And therefore, we will get the revised figure of goodwill as well. And in terms of P associate, we take the PC, compare this with the share in net assets. And therefore, we will get the figure of goodwill in this case. Okay, so now let's consider the purchase consideration. I think the purchase consideration subsidiary is 1 lakh. Associate is 21. NCI on the date of acquisition is 55. And net assets, you've got in step number 2B. Step number 2B, net assets is 120 and 60. So this is 1,20,000 and this is 60 and the percentage I think was 30% if I'm right. Associate, I think the percentage was 30%, correct. So this will give us the goodwill. So this is 18,000. So this goodwill is supposed to be 3,000, part of the carrying value. So this is 155 minus 120. This is 35. Impairment, do we reduce 7,000 or do we reduce 60%? We reduce the full goodwill impairment. So the goodwill becomes 28. Right, so that's right. Entire amount stands reduced. So this is step number 5. Now, before you go to the step number 6, we just said we are introducing another step, and that is step number 5A, which is for calculating the investment value. So let's add on another step now, that is step number 5A. This is going to be added only if you are given an associate company. If you're given an associate company, then we're going to add another step number 5A to calculate the investment in associate, because one line consolidation needs to be done. So let's get the investment in the associate company. So for the investment in associate, we take the investment 21,000 as a base. I guess there are no adjustments given in this case. So the only thing to be taken is the post-acquisition profits. So we can just add the share in post-acquisition profits. The associate company earned a profits. And when the associate company earns a profit, the net assets goes up and therefore the investment goes up to the extent of share. So let's see the post-acquisition. 15,000 is the post-acquisition profits. And out of this, 30% belongs to the investor. That is 4,500. So we get the investment value. That's 25,500 is the value of the investment. Okay, so that was step number 5A. Then finally, step number 6, which is other equity, and then consider the consolidated balance sheet. So let's consider the step number 6, which is getting the consolidated balance sheet, other equity. Now here again, you've got a total of 3 focus points. And when you get 3 focus points, in this particular case, you can say 3 focus points for the subsidiary and 3 focus points for the associate as well. So one is the post-acquisition profits, one is the goodwill or the investment impairment, and one is the stock reserve, which is upstream in both the cases, right? So in this particular case, though in associate, it will be down and up both. So the focus points will remain the same, that you need to consider the share in post-acquisition profits, you need to consider the goodwill or the investment impairment, stock reserve upstream for a subsidiary, but it's going to be down and upstream for associate, because that hits the other equity. So let's do one thing. Let's consider the holding company's own equity. So I think we've got 2 elements, RE as well as other components. So we've got retained earnings and we've got the other components. And where do you pick up this information? Extract balance sheet, because you've already made an extract balance sheet. So you're going to pick this from the extract balance sheet. This is 170, if I rightly remember. So this is picked up from the extract balance sheet. Retained earnings is 170. And what about the other components? That's 10,000. The other components are supposed to be 10,000. So let's now consider the share in post-acquisition profits. So we've got share in post-acquisition profits. So for that, we go back to the step number 2A for the analysis of equity to get the post-acquisition share. So 17 in the RE and 5 in the other components, and that is 15. 17 and 5. So we consider retained earnings 17 into 60%, and this is going to be 5 into 60%. This is the post-acquisition profits in the subsidiary. Then we also need for the associate, and that was 15,000 into 30%, which you've taken here as well. So this is going to be 4,500, and this is 3,000, and 17 into 60%, that's 10,200. Right, so this is the post-acquisition earnings. Now there is goodwill impairment. There is no investment impairment, but we need the goodwill impairment. And how much do we consider on the goodwill impairment? 7,000 or 60%. Goodwill was reduced by 7, NCI borne that 40%. So here we consider 60%. That's right. So 60% would mean 4,200. And then there is a stock reserve also to be considered, which is downstream in nature. So let's consider the stock reserve as well. So let's go back to the additional information on the stock reserve. So here we're given the stock reserve calculations. It says B sold goods to H for 10,000 at a 50% margin. So on 10,000, a margin of 50% would mean 5,000. Then he says H sold 80% of these goods. So 80% goods are sold. So stock reserve will be on the unsold goods, that is 20%. So 5,000 is the total profit. 20% unsold, stock reserve is 1,000. So stock reserve is going to be to the extent of 1,000. It gets reduced from the RE. I think that gives us the sum total 170 plus 10,200 plus 4,500 minus 4,200 minus 1,000. This is 179,500. And this is going to be 13,000. Oh, wow. So the step number 6 is also taken care. And now we need to make the consolidated balance sheet. You want me to make the balance sheet right away, or you want me to give you the break first? So whatever is the desire. So you want me to first give you a break and then make the console, or you want me to make the balance sheet and then give you a break?
We'll make a balance sheet and then.
Okay, wonderful indeed. So let's make the consolidated balance sheet as well. So here, once we make the consolidated balance sheet, we need to be picking up the figures of the parent and the subsidiary, not associate, and adjustments, and then the total. Associate would be just a one-line consolidation. So this is my step number 7, which is making a consolidated balance sheet, holding company, subsidiary company, adjustments, as well as the total. So let's go back to the balance sheet. So we'll have to pick up the figures. Let's add the PPE, 1 lakh plus 80. I think we'll have to keep jumping on this. I'll go back to 40 and 47. Okay, so let's consider the PPE. So I'm just taking the headings PPE. This was, I think, 1 lakh, and I forgot what was the subsidy figure. So 1 lakh and 80. So this is 1 lakh and this is 80. And there was some fair value increase, I guess 15. There was an additional depreciation, I think that was 3. I think that's correct. So 1,80,000 plus 15 minus 3, that's 192. I think least we forget, let's take goodwill. That's 28 if I rightly remember. Then let's go back again to the balance sheet. So investment done. Then we need investments in associate. Inventory is 22 and 30. Inventory is 22 and 30. So we'll take investments. Then there is inventory. Investments, I guess we just worked out in step number 5A, 25,500. This is the investments in the associate company, where you can show the goodwill in the brackets. Then inventories. Inventories is 30, 22 and 30. This is 22 and this is 30. Then I think there was a stock reserve of 1,000. Then there is trade receivables. This is, I guess, 51. Then trade receivables, I think there is some intercompany owings, I guess. 70 and 10. And I think in the trade receivables, we're also given that there is a 5,000 intercompany owings. So 70 and 10. So this is 70 and this is 10. And there is an intercompany owing that is 5. That makes it 75. Then I think there is cash and cash equivalents. So cash and cash equivalents, that is 47 and 25. 47 and 25. There is no adjustments on the cash and cash equivalents. That works out at 72. Wow. I think that's it on the asset side of the balance sheet, I think. Yes. So let's get the total of the balance sheet asset side. 192, 28, 25, 500. This is, I think, coming to 443, 500 is the total. Okay, then we go to the liability side. And liability side, we have equity share capital would remain at 1 lakh. Equity share capital would remain at 1 lakh. And for the other equity, we can pick up the information. Step number 6. So 179,500 and 13,192,500 is other equity. And do you remember what was the NCI? I think it was 61. And then finally, I think there's just one more item on the balance sheet. Liabilities is 50, but extract balance sheet changes it to 80. So provision for damages, so 50 plus 30. So 50 and 15. So this is going to be liabilities. That was 80 from the extract balance sheet. And this is 15. There is an intercompany owings that is 5. So that makes it, I guess, 90. Okay, so I think that's it. Did we miss out anything or this is done? Yes, the balance sheet is, I think, wonderfully tallied. That is 443,500 is the total of the balance sheet. Wonderful indeed. Wow. So I think that gives us a comprehensive question. When you get a subsidiary and an associate put together, a blend of 110 and a blend of Indus 28. Wonderful indeed. So once you try this question with your own hands, you'll get more confidence. Please do that. and you will get more confidence in terms of things. This was balance sheet. Now we're going to do another question. First, we'll give you a break. Then we'll do a question which is on an associate and a subsidiary, a consolidated P&L. That will, I think, cement our entire concept. Right, friends. So I think time to give you some break now. And then I think we commence back a journey on the consolidated P&L. Please enjoy your break. Thank you. I hope you had a relaxation of mind. So now we are going to go to the next agenda, another comprehensive question, which is going to be a blend of subsidiary associate with a consolidated profit and loss. So let's begin the next one. So I'll share another question to you. So this also contains an associate as well as a subsidiary. So let me just zoom this first to you. So we've got three companies, the parent, the associate, and the subsidiary. So let's first read the inputs what are given. So we're given the information of the question. It says H has got 80% ordinary shares of S and it has got 30% ordinary shares in A for many years. Now, when it says many years, what immediately comes to the mind is that current year is post-acquisition. Because when you acquired them many years ago, the current year is post-acquisition because that is the very first focus point. So we can say current year is 100% post-acquisition in nature. Because I gave you three focus points in a consolidated P&L, and the very first focus which I give you is looking at the rate of acquisition, which will decide the fate that whether current year is to be consolidated 12 months or proportionately. Then he says the information below is required to prepare a consolidated P&L for the year ended 30th June X8. There were no items of the OCI in the year. And then it says at the date of acquisition, the fair value of S plant and machinery, which stood at that time, had a remaining value of 10 years, exceeded the carrying value by 10,000. And that's a fair value adjustment. And you know that because of the fair value adjustments, we will increase the amount of depreciations in the P&L. Then it says during the year, S sold goods to H, that means it is upstream in nature, for 10,000 at a margin of 25%. And by the year, H sold 60% of these goods. That means what is unsold is equal to 40% at this stage. Then he says the group accounting policy is to measure the NCI using PASNA proportion of net assets, and the current year impairment is given, and this should be charged as a part of the administrative expense. So we're given the impairment, we're given the fair value adjustments, we're given the stock reserve. Then he says on 30th June, the investment in A also stands impaired by 450. But out of this, the current year is 150. 300 is prior to the current year. Then he says on January X8, H, that is the parent company, signed a contract to provide a customer with support services for 12 months. Now, my financial year is ending on June X8, and this agreement is signed in the middle of the year. That is on 1st January. And we are providing support services for a period of 12 months. H received the full fee in advance and recognized this as a revenue. So the parent company got a 12 months money and he has taken the entire 12 months money as revenue, whereas only 6 months should be a revenue. The rest 6 months should have been taken as an advance, as a liability. So in this particular case, I think the rectification of the parent company's revenue is required. Now, this is not an adjustment pertaining to consolidation, but this is an adjustment which is more like, a rectification of errors. The parent company has taken the entire amount as revenue, whereas only 6 months was revenue, rest is an advance. We're required to make a consolidated statement of P&L for the year ended 30th June X8. So not very complicated. I think in terms of associate, there is just one adjustment, that is investment impairment. Rest, I think, is pretty simple. Let's begin. So let's first of all make a format for a consolidated P&L. Now, the focus needs to be very clear that when you consider the consolidation of a subsidiary and associate, subsidiary is going to be line by line and associate is just one line. So in the profit and loss, you will just take the share in the post-acquisition earnings. So we'll make the columns for consolidated P&L. So one column for the parent company, one is for the subsidiary, one is for the adjustments, and one for the total. No column required for the associate company. So parent company, subsidiary company, adjustments, and the total. So this is the consolidated profit and loss. So as we'll keep taking the figures, whatever adjustments are required, we'll simultaneously make those adjustments as well. Let's begin with the revenue data. So I am given the revenue data that is 5 lakhs and 2 lakh. The revenue is 5 lakhs and 2 lakh. So we take care of the revenue that is supposed to be 5 lakhs and this is 2 lakh. Now there are two adjustments required in terms of revenue. One is the intercompany sale purchase between the parent and subsidiary, and one is the incorrect recording by the parent. Let's first take care of the incorrect recording by the parent. On January X8, H signed a contract with the customer, giving services for 12 months. He received the full amount of 30 and took the full amount as revenue. So only 15,000 should have been taken as revenue. So what we can do, eliminate this 15,000 because this is like an advance. So he has taken that entire 30 revenue, but we should not have taken this money. That is one. Second, during the year, S sold goods to H. As of now, it does not make a difference whether it is upstream or downstream in nature. That would be in terms of NCI. So it's an upstream transaction. S sold goods for 10,000. So what we're going to do, eliminate this 10,000 also from the sales. The intercompany sales will get eliminated. So this is going to be 7 lakhs minus 25. This works out at 675. So the revenue is done. Now let's go to the next adjustment, next line item. So we've got cost of sale 1 lakh and 80. So cost of sale is 1 lakh and 80. So cost of sale is 1 lakh and this is 80. First, we need to eliminate this 10,000 intercompany sale and we need to add the stock reserve. Now let's calculate the stock reserve. It says S sold goods for 10,000 at a margin of 25%. So 10,000, 25% margin would mean 2,500. And then it says by the year end, H sold 60% goods. So only 40% is unsold. So 2,500, we take 40%. Stock reserve to be added is to the extent of 1,000. Let's see if there is anything else to be taken. So I guess there is an impairment and there is a goodwill impairment and investment impairment that will be taken care later. And there is another item as well. There is a fair value adjustment. Now, I guess the fair value adjustments will lead to additional depreciation, and we need to decide the appropriate head where this additional depreciation will get captured. Now, if you look at the P&L, I think depreciation cannot be a part of distribution or administrative expense. So I think the only logical head which seems to be taken is the cost of sale. So we need to be careful that when you're inserting the expense, it should be added to an appropriate heading as well. So in this particular case, this additional depreciation will take it in cost of sale. So the fair value of the plant and machinery had a remaining life of 10 years, exceeded 10,000. So we can say the current year depreciation is going to be 1,000 extra. So we take this 1,000 additional depreciation as well. So just for reference, this is stock reserve and this is the additional depreciation, just to give you the track. So this is going to be 1 lakh 80 minus 10 and this is going to be plus another 2. That makes it 172. So this will give me the element of gross profit. So we are taking the GP. Though I think if you look at the Indian scenario, there is no GP in the income statement, but this is a little international question. So therefore you see the gross profit in the format itself. So otherwise you don't see the GP. So don't get worried if you look at the GP. because this is more like an international question. So this comes to 5,03,000. What is the gross profit? Okay, so the intercompany sales elimination done. The stock reserve is taken care. Additional depreciation is taken care. Let's go to the next item now. So we are given distribution 160 and 20. So the next item is distribution 160 as well as 20, and there is no adjustments. That is 180. Then we take care of the administrative expense. Administrative expense is 140 as well as 40. So this is 140 as well as 40. And I think there is something which is given for the administration code. So we are given on the para number 2, it says the current year goodwill is impaired by 1,200, and this should be taken in the administrative expense. So you can take this 1,200, that is goodwill impairment, as a part of the administrative expense as mentioned in the question. So that's, I think, 181,200. So with this, we'll be able to get the operating profits. So with this, we will get the operating profits as well. So 5,03,000 minus 180 minus 181,200, that's 141,800 is the total operating profit. So let's go back on the question. So operating profits is done. Then there is an interest income, and I don't think so there is any adjustments on the interest income as well. So let's continue with this format. So let's make an extended version. One column for the parent, subsidiary, adjustments, and the total. So holding company, subsidiary company, adjustments, and total. Let's take the operating profit, 141,800. That is the operating profit. So this is the operating profit. Then there is interest income. The interest income is 1,000. There is no adjustment. It remains at 1,000. Now, at this stage, I think since we're looking at the incomes, let me also consider the share of the investor in the associate as well. So let me add at this stage the share of the investor in the associate company, one line consolidation. So let's go back on the associate company. So as far as the associate company is concerned, we can clearly see that the associate company has got a profit of 26,000. And this is entirely post-acquisition in nature. So out of this 26,000, 30% belongs to the investor. But there is one adjustment. The investment is impaired by 450 and the current year impairment is 150. So we'll take care of that impairment also from there. So we can take this as 26,000. This is going to be 26,000 into 30% and reduce the impairment of the investment from this share itself. So 26,000, 30% minus 150, it works out at 7,650. So this will give us another profit in the question. So this is given to me, it's PBIT. So let's get the PBIT and then interest expense. So this is my PBIT. Then there is interest expense. That's 2,500. So let's get the PBIT first and then reduce the 2,500. So 141,800 plus 1,000 plus 7,650. It comes to 150,450. Right, so the interest expense is also taken care. And then I think the only information left over is tax 23, 21. Taxes 23 and 21. So let's get the PBT. And we get the tax that is 23 as well as 21. So that comes to 44. Let's first get the PBT. 150, 450 minus 2500, 147, 950. And then 147, 950 minus 44, that's 103, 950. So that comes to 103, 950. This is the profit after tax. Now, there is a need to make a scrutiny of the additional information for anything which is left out. Let's go back to the question and let's see all the additional informations at this stage. So as far as the fair value adjustment is concerned, additional depreciation is taken in cost of sale. Stock reserve is concerned, it's taken in the cost of sale. Then impairment of goodwill taken in the administrative expense. Investment impairment taken in the share and post, and the rectification of this is also done. I think everything is done, but the P&L is not complete. We also now need to split the profits between the NCI and the parent. So let's come back. I think let's now show the segregation of this 103,950. So I'm just taking the figure 103,950. And we will consider what is the profits attributable. What is the profits which is attributable to the NCI and to the holding company. So NCI will be computed based on book earnings or based on rectified earnings. I think let's ask you that. Book earnings or rectified earnings? So when we consider the NCI share in profits, undoubtedly we need the rectified profits as we decided earlier in the consolidated P&L. So we take the reported profits and convert that. Let's consider the reported profits. And then we need to take care of three adjustments. One is the stock reserve, which is upstream. One is the goodwill impairment, and the other one is the additional depreciation. So we need three adjustments in this case. Stock reserve, which is upstream. Then there is goodwill impairment if the NCI is at a fair value. In this case, the NCI is at PASNA, so we're not taking the goodwill impairment. And then there is additional depreciation. Stock reserve was upstream, I think it was 1,000. Additional depreciation was 1,000. And I think we can just go back to the reported earnings. The reported earnings of the subsidiary is 39,000. So we take care of this reported earnings 39. And we will be able to get the rectified earnings as well. So this is going to be 37,000. That is the rectified profits of the subsidiary company. So out of this 37,000, 40% belongs to the NCI, 60% is with the parent. So this comes to 14,800. So we can comfortably get the balancing figure belongs to the parent. So this is 89,150. That is the balancing figure. Wow. So I think this takes care of the agenda in terms of equity method of application, looking at the combined inputs in terms of subsidiary, associate, consolidated balance sheet, consolidated income statement, all done. So that takes care of my block number 2. But I'm still not complete on the associate accounting. Now, as I said, in terms of block number 1, one issue was pending, and I think I'm going to first take that pending issue with you. And that pending issue is in terms of the scope of the standard. So we divided Ind AS 28 in three parts. One is, we said, the assessment of a significant influence, and there is a scope, just like Ind AS 110. So we are yet to discuss a little part on the scope, which is given in the study mat as well. The second block is the consolidation technique. There is equity method done. The third block is going to be the other long-term interest in the associate company. But first, I think we'll come back to the scope of the standard. Now, for this purpose, to understand the scope of the standard, there are some interesting inputs in the standard. There is a para number, you can say 18 and 19, which contains something very interesting. I have just taken the extracts of those para, and I'm going to share that for understanding purposes. So there is a para number 18 and para number 19. So let me share the inputs in terms of para number 18 and 19 with you. Now watch this carefully. We're going to do some case studies also on this. So I'm going to first read this input to you. We are on block number 1. And in terms of the block number 1, we're discussing the scope of the standard. A very interesting inputs in para 18 and para 19. So we'll start first reading this, analyzing this. It says, when an investment in an associate or JV is held by or is held indirectly through. When it says indirectly through, it has to be a subsidiary. If you remember my discussions in the previous class, I said that you may directly have a stake in the company, or you may indirectly through a subsidiary have a stake in the entity. So it says there are two things. Either it is held directly or it is held indirectly through a subsidiary. It says an entity. So when an investment in an associate or joint venture is held by an entity, that is a venture capital organization, a mutual fund, a unit trust and similar entities, including investment-linked insurance funds, the entity may elect to measure that investment at FPTPL in accordance with Ind AS 109. An entity shall make this election separately for each associate or a JV at initial recognition of the associate or JV. I think let's visualize what the para number 18 is telling me. I'll give you two cases. One is a case where it is directly held, and one is a case where it is indirectly held, so we can get a clarity of thought. Let's, I think, visualize. Let's say there is a company A and let's say there is a company B. And let's take another case. There is a company A and then there is a company B and then there is a company C. It's like a chain. It's like a chain. Now, I'm going to look at two separate cases. Number one, let's say A, the investor, is a venture capital organization or is a mutual fund. Let's say A is a venture capital organization or is a mutual fund. That's what it says. When an investment in an associate or JV is held by an entity that is a VCO or a mutual fund, unit trust, etc. So let's take it as VCO, venture capital and mutual fund. So as an investor, my company is a venture capital organization. My company is a mutual fund or a unit trust. It says the entity may elect to measure that investment at FPTPL. Now let's say A has got a significant influence over B. So A gets a choice. We tell A that you want to apply equity method of consolidation. You want to apply FPTPL in accordance with 109, your choice. It's a choice. It's not mandate. It says it may elect. So in this particular case, we can say that A will get a choice. A will get a choice in this case, and the choice is that either he applies an equity method as per Ind AS 28 or he applies an FPTPL as per 109. So equity method as per 28 or FPTPL as per 109. This is direct. I hope I stand very clear on my thoughts. So, as an investor, you are a venture capital organization, you are a mutual fund, you are a unit trust, and you've got a significant influence over the associate company. So, I will tell A that you've got a choice either to apply equity method of accounting under 28 or you can apply FPTPL under 109. It's a complete choice. Clear, I guess, clear with this fact so far? Let's then go further. Now, before we come to the para number 19, let's, I think, have a little flair on the other part as well. Now, let's consider in this particular case, B is supposed to be a venture capital organization or a mutual fund or a unit trust, not A, not A. So let's say A has got a control over B, and let's say A has got a 10% stake in C and B has got a 10% stake in C. So C becomes an associate. C becomes an associate in this particular case. Now, I think let's first read the para number 19 and then decide, because para 19 is, talking about that indirectly held portion as well. So let's first read para number 19. So it says in terms of para number 19, it says when an entity has an investment in an associate, can you see here it was associate or a JV, and here he is talking only of an associate. It says a portion of which is held indirectly through VCO or a mutual fund or a unit trust. So can I say A is indirectly through a subsidiary is got investment in C, which is through a VCO or through a mutual fund. So A has got direct and A has got indirect. So it says when an entity has an investment in an associate, a portion of which is held indirectly through a VCO. So a portion is this. So I think we're doing two technical discussions at the moment, and it does a bombard. Okay, so let me just come back on the para number 19. So in the meantime, as the file opens, let me just, I think, remind you. So we're looking at two cases. One is as an investor, you've got directly in the associate company. So as an investor, you are a venture capital organization, a unit trust, or a mutual fund. Or the second possibility is that, it's a chain holding where as a subsidiary, as a parent, through a subsidiary, which is a VCO or a mutual fund, you get a stake. So let me just come back on the agenda. Okay, so coming back to the agenda, so we were looking at the para number 19 in this case. So in terms of the para number 19, when an entity has got investment in an associate, a portion of which, so this is direct, indirect. So this is one portion and this is another portion. So there are two portions of the investment. One is direct and one is indirect. So we're looking at that indirect percentage. It says in this particular case, the entity may elect to measure that portion of the investment at FPTPL in accordance with Ind AS 109, regardless of whether the venture capital organization has got a significant influence over that portion or not. So the interesting part is that if B individually has got a significant influence over C or not, that will not make a difference. You establish the significant influence relationship because A directly plus A indirectly put together has got a 20% stake. So C is an associate. He says in this particular case, what you can do, you get a choice. You get a choice for this portion. So you get a choice only for this portion. You get a choice for this portion. Not for the direct portion, but only for the indirect portion, you get a choice that either you can apply the equity method of consolidation or you can consider this investment at FPTPL. That's what it says. He says the entity may elect to measure that portion of the investment at FPTPL regardless of whether there is a significant influence for that portion. So whether this is standalone, a significant influence or not, doesn't make a difference. If A in C and A through B in C is got a significant influence and a combo offer, whether B individually is got a significant influence or not would not make any difference in this case. And then it says, then he adds on further, it says, if the entity makes that election, the entity shall apply the equity method to the remaining portion of the investment, which is not held through a VCO. So in this case, it says that for this particular portion, you will definitely apply equity method. So for this particular portion, you can say equity method becomes mandatory. For this particular portion, the equity method becomes mandatory. So I think let me just consolidate this, then we can do a case study based on this. So we can say there are two cases, simple cases, which I'm looking at. One is a case where it is not a chain, and one is a case where there is a chain. So the paragraph 19 will apply when it's a chain, remember, because in this case, he's talking about a portion of the investment held indirectly. So you can say that para 17 is more or less focusing non-chain holding. Sorry, para 18 is focusing non-chain holding and para number 19 is focusing on the chain. So when you say that as an investor, you yourself is a venture capital organization or a mutual fund or a trust, and you've got a significant influence over another company, you get a choice to apply equity method or you get a choice in terms of FPTPL. It's a complete choice. You do whatever you want. The second is when it becomes a chain holding, you can say there are two portions of the investment. One is a portion which is held by A. Of course, I'm assuming that A is not a VCO. And the other portion is which is indirectly held through a subsidiary. Now, the portion which is directly held, you will apply equity method on a mandatory basis. And for the portion which is indirectly held through a VCO, you again get a choice. And this choice is available even if B individually does not get a significant influence over C, it does not make any difference to the analysis. Right? I hope, friends, I stand clear on the application of para 18 and para 19. Let's first document this, then we'll do a case study on this. Let me first document this and let's pen down the thoughts. So this is a part of my block 1 discussion. That is the scope of Ind AS 28. So we're looking at the block number 1, looking at the scope of Ind AS 28. So I'm just coming back on the block 1. The block 2 is done. Block 1 assessment was done. So here the focus is in terms of the input given in para 18 and para number 19. So let's make a summary chart indicating the inputs in terms of para number 18 and in terms of para number 19. Now, in terms of para number 18, I would say per se there is no chain. And in terms of para number 19, I would say per se there is a chain. There is going to be a chain. So I think if I take an example to fit this, let's say this is A and let's say this is B. And let's say this is A and this is B and B has got stake in C. So A has got a significant influence over B, A has got a control over B, and B has got, you can say, not exactly significant influence, but it's like this. So let's put it like this, that A in C plus B in C that achieves a significant influence, not necessarily individually. Not necessarily individually. So it may not be on an individual basis, but it would be on a combined basis. So A in C plus B in C achieves a significant influence. Okay, now let's consider the inputs in this case. So when I say A is got in B a significant influence, so we're saying A is a venture capital organization, it is a mutual fund, or it's a unit trust. So I think I'll just spread the words VCO, that's venture capital organization. So it's a venture capital organization. So a venture capital organization, can get a significant influence over the investor because he's putting in money. But the idea in this case is that they don't want a significant influence as such, because they put in money. So as a part of the protective rights, they want to basically, get that percentage. So it's not necessary, we tell them that you apply an equity method, because they are also getting this percentage stake by default as well, being a financer to the company. And then MF would be mutual fund. So even if you're a mutual fund company, you may be holding a certain stake. Or if it is UT, that is a unit trust. So we can say if A, the investor himself is a venture capital organization, mutual fund, or unit trust, then we can say in this particular case, A gets a choice. In this case, A gets a choice, and the choice is either he applies Ind AS 28, that is equity method of consolidation, or he applies Ind AS 109, capture the investments in the balance sheet at FPTPL. Okay, now come to the case para number 19, and in terms of the para number 19, so we can say that as far as A is concerned, there are two portions of the investment. There are two portions of the investment. And in this case, we are saying that B is the venture capital organization or the mutual fund or the unit trust. So B, the subsidiary, is there. So here we can say there are two portions of the investment. So one is directly held. So one is, you can say, directly held, and one is, you can say, indirectly held through subsidiary. So it is indirectly held through subsidiary. So these are the two portions of the investment. One is directly held and one is indirectly held. So on the portion which is directly held, the equity method becomes mandatory. The equity method becomes mandatory. And for the portion which is indirectly held, here again, he gets a choice. So here again, he gets a choice. He can either apply Ind AS 28 or the concept of FPTPL. Wonderful. So I think the para 18 and para 19 gets summarized. that in terms of para 18, when there is no chain, what is to be done? And para number 19, when there is a chain, what is to be done for the two different portions? Directly held equity, indirectly, you get a choice. Okay, now I think let's begin with a case study based on this. So I have a question which I'm carrying on this area. This is in the education material as well, and it came in the RTPs in May 20 as well. So let's have a look at this question. So this is the question which came in the revisionary test papers in May 2020, and this is also given in the education material on India's 28 issued by the Accounting Standard Board. Let's, I think, read the inputs out here. It says entity P is the parent. It has got two wholly owned subsidiary X and Y, each of which has got ownership interest in the associate Z. I think let's visualize the diagrammatic view. It says there is a company that is P, and it says that this company has got two wholly owned subsidiary, 100% stake. It has got 100% stake in X and Y. Then he says that each of them has got ownership interest in Z. So each of them has got ownership interest in Z. So this is making, you can say, a significant influence. Okay, then it says further, subsidiary X is a venture capital organization. So this is a VCO. So P is got indirectly through VCO, though it is also got indirectly without VCO. Okay, then it says further, neither of the investments held in the associate by subsidiary is held for trading. So they are not held for trading. Subsidiary X and Y account for the investment in associate at FPTPL in accordance with 109 using the equity method in accordance with India's 28. So it says X is applying the concept of FPTPL and Y is applying the concept of equity method. How should P account for the investment in associate Z? So he's given you that how X and how Y is doing. Because X is, you can say, applying the para number 18, and by applying a para number 18, he's taking FPTPL. And Y is not getting the benefit of 18, so he is doing Indus 28. So he tells me the status that as far as X in the standalone financial is concerned, is applying Indus 109, that is FPTPL. And Y is concerned, he's applying Indus 28, and that is equity method of consolidation. And that's fine because X is availing the para number 18 and Y cannot avail the para number 18. Now he says, how should P account for the investment? Now the agenda is, how would P account for this investment in Z? Now let's read further. There are three scenarios given. Both investments in associate result in a significant influence on a standalone basis. X and Y have got 25 and 20%. So individually, they are associates. That is scenario one. Then he says when neither of the investments results in a significant influence on a standalone, but they do provide the parent with a significant influence on a combined basis, it's 10 each. So the first case is that X in Z individually SI, Y in Z individually significant influence. The second is X and Y combined. And if you remember, we said it does not make a difference whether individually it becomes an associate or not. So the answers to scenario 1 and 2 cannot undergo a change. Then he says when one of the investments in associate results in a significant influence on a standalone basis, but the other investment does not result in a significant influence on standalone, it's like 30 plus 10. all said and done, whether individually it's an associate, whether combined they are associate, whether individually one is associate, another is not, it doesn't make any difference at all. The scenario number 1, 2, 3, it does not make any difference. The answer is common. And what is the common answer in this particular case? The common answer in this particular case is that when P accounts for the portion, which is held through X, this is indirectly through a VCO, so he gets a choice. And for the P, the portion which is held through Y, can I say this is not through a VCO? So in this particular case, he will have to apply the equity method of consolidation. Now, whether this individually results in a significant influence or not does not make a difference. That is very clearly stated in para number 18, that whether he gets a significant influence on a standalone basis. So when he is telling you all these three situations, that this is significant, this is significant, this is individually not significant, or this is significant and this is not, it doesn't make a difference at all. To the extent Z is an associate of the company P will get an option of applying the para number 18. So one thing which I like to pinpoint very clear, X availed, you can say para number 17. And P in this case is going to avail the para number 18. Sorry, para 17 I'm saying, para 18 and 19. So in this particular case, we can say he availed the advantage of para number 18 and he can avail the advantage of para number 19. Because in terms of X and Z, it's not a chain. But in terms of P, X, and Z, it becomes a chain. I hope I stand very clear on my thoughts on the concept of chain and no chain, para number 18 and para number 19. Okay, so far so good. So I think that decreases of a scope as well. So we will do equity method considering a 10% share in profits. Yes. Let's say, for example, that P through Y has got a 10% stake in Z. We will apply the 10% share in profits. The equity method of application will apply with the 10%, rightly said. Right, friends. So I think this takes care of my block 1 and block 2. Now, in terms of block 1, assessment of significant influence and the scope is done. And the block number 2, which is the equity method of consolidation, done. Now, there is a next agenda in terms of the standard, that is understanding the accounting for other long-term interest in an associate. Apart from the investment in equity, you've got investments in other long-term interest, but they would be something which is, special in nature. Now, what is that special in nature? That is addressed by the appendix in the standard. That issue we'll discuss in the next class. So we'll discuss that particular issue and we'll also start a journey in terms of Ind AS 111 in the next session with you. Right, friends, so that seems to be all good for the day unless you've got questions. So please do revise all this. Right, I think that seems to be all good. Right, friends, so I think that's all for the day. So thank you very much for joining. So see you in the next class with some more inputs on 28 and Ind AS 111. Thank you very much. Thanks a lot. Bye-bye and take care. Anji, thank you.
Thank you, sir.
Thank you, Vida.